Tesla reported second quarter results today, and there were a couple of negative items that came out of the shareholders' letter. One, the average selling price of the Model S fell when compared to the first quarter, and that led to a gross margin miss of about 100 basis points. And two, management lowered their full year 2015 delivery guidance by about 5,000 vehicles. As a result, the share price declined by about 6% in after hours. So we're going to plug the new guidance and the new data from the shareholder letter into our earnings model and determine if that 6% decline makes sense. So if we start by scrolling down to a couple of the key items from the 2Q results section of the shareholder letter, you can see, so they did give guidance that the average selling price of the Model S would decline. They cited foreign currency and a change in product mix last quarter. If we scroll down to the Model S section of our earnings model, you can see during the first quarter the average selling price was just over $100,000. Now the average selling price in the June quarter fell to just under $96,000. One small bright spot was the automotive revenue, including the regulatory credits. So they had guided to 15 million in total regulatory credits last quarter, and now they actually reached 27. So that helped a little bit. But the automotive gross margin declined to 23.9% on a non-GAAP basis. So you can see in the model, for the first quarter, they actually reached 26%. And they even guided next quarter to be slightly below the second quarter. So it's definitely not following a great trend here. We scroll down to the guidance. That's where we're going to get the additional details for the earnings model. So we've highlighted some of the key items. They expect to produce just over 12,000 vehicles in the third quarter. So where some of that will be Model X deliveries. We don't know exactly how much of it, but for now we have the majority of it coming in as Model S vehicles. They've trimmed their delivery target to between 50,000 and 55,000 for the full year. So we have now updated the model to include to reach the midpoint of this guidance. So we have 50,000 Model S deliveries and we have 2,500 Model X deliveries. One kind of positive is that they say here, looking ahead to next year, we are highly confident in a steady state production and demand of 1,600 to 1,800 vehicles per week. So obviously they're still ramping. They're saying steady state, but if you take the midpoint of this range and you divide it out by a full 52 weeks evenly, then you get to a total of just over 88,000 vehicles for the 2016 year. That was actually a little bit higher than what we were modeling before. So that's going to be a benefit to our discounted cash flow valuation approach, actually in our multiple-based approach, since our multiple is based on the full year 2016 earnings. Model S average selling price is expected to decline by more than 100 basis points. So in our model, it's hard to say exactly how much more than 100 basis points, but we have just included a full 1 percentage point drop. So you can go, if you want to be more conservative, you could change this to 98.5, and that would be 150 basis points, but we just left it at straight 100. So depending on where this comes in, we could be a little bit too aggressive on this estimate. Still not a great trend, going from $100,000 per vehicle to $95,000 in the third quarter. And they also just say here, we expect non-GAAP automotive gross margin, excluding the zero emission vehicle credits, to be just slightly below the 2Q level. So we took off 10 basis points from the gross margin from last quarter. So they're going to start the production of Tesla energy products, and they expect that to impact the other revenue. So we do have a section in our model for energy products, which we're putting as basically ramping in the fourth quarter. But for right now, they're including that in the services and other revenue. So that's where we have it just for the next quarter until we actually have some meaningful earnings. So they say that they expect other revenue to grow modestly. Not really sure exactly what they mean by modestly, but we put a 5% growth rate for next quarter. And they expect the gross margin to be comparable to 2Q, so we've set it at 2.2%. They expect operating expenses will grow 5 to 10% sequentially in Q3 and 45 to 50% for the full year. So in our model, we've set OPEX equal to the midpoint of both of those ranges, so 7.5% for the third quarter. And they still expect 1.5 billion in CapEx for the year. So we've included that in our cash flow model. So after updating the quarter, the June quarter results and the additional guidance that we got, our model actually shows a price increase. So on the left-hand side of the screen, this is the model that we walked through last night in the preview, and it was valuing shares at $270, and now we're actually showing a price increase at $275. Part of that is the fact that we haven't changed our 2016 gross margin or Model S prices. So if the price continues to decline and margins continue to compress, then this 275 mark will be a little bit aggressive. So it's really going to come down to what the consensus estimates come out tomorrow once analysts update their model. But for the time being, it looks like that 6% decline might be a bit much. If you'd like to download this model and plug in some of your own estimates for the Model S average price or gross margin or energy products or any other of the details in our segments, please visit our website at www.gutenbergequityresearch.com. From the Models in Focus section, you can click on Tesla and see more details about how this model works. You can also watch a video that explains our DCF and market multiple valuation approaches. And you can download the Tesla model by visiting our model store and scrolling down to the Tesla thumbnail. And from there, you can just 2 clicks away, and it's only $5 to download. Be sure to check back tomorrow or later this week after all the analysts' estimates are in. We'll recalibrate this model to meet those expectations. And later on in the quarter, we'll update the DCF section for the new equity risk premium and interest rates. Thanks for watching.